Monetary policy versus fiscal policy. Tools for economic management. Monetary policy and fiscal policy are two primary tools used by governments and central banks to influence economic activity, stabilize markets, and achieve macroeconomic objectives. Each policy lever operates through distinct mechanisms, impacting monetary conditions, government spending, and economic growth. 1. Monetary policy overview. Monetary policy refers to actions taken by a central bank, such as the Federal Reserve, Fed, in the United States, to regulate the money supply, interest rates, and credit availability in the economy. Its primary goal is to achieve price stability, full employment, and sustainable economic growth by influencing borrowing costs and consumer spending. 2. Tools and implementation. Monetary policy tools include open market operations, buying and selling government securities, setting the discount rate, interest rate charged to commercial banks for borrowing funds, and establishing reserve requirements, minimum funds banks must hold against deposits. These tools adjust short-term interest rates to stimulate or restrain economic activity based on inflationary pressures and growth objectives. 3. Impact on economy. Monetary policy affects consumer borrowing costs, business investment decisions, and overall economic activity by influencing liquidity conditions and credit availability. Lower interest rates encourage borrowing and spending, stimulating economic growth during downturns, while higher rates curb inflation and prevent asset bubbles. 4. Fiscal policy overview. Fiscal policy refers to government decisions regarding taxation, spending, and budget allocation to influence economic activity and achieve socioeconomic objectives. It involves legislative measures to adjust revenue collection, public expenditures, and deficit financing to stabilize the economy and promote long-term growth. 5. Tools and implementation. Fiscal policy tools include changes in tax rates, income, corporate, consumption taxes, government spending on infrastructure, social programs, and public services, as well as deficit or surplus management through borrowing or savings. These measures aim to stimulate demand, create jobs, and support economic sectors during recessionary periods or promote fiscal discipline during economic expansions. 6. Impact on economy. Fiscal policy directly impacts aggregate demand, consumer purchasing power, and business confidence by influencing disposable income, investment incentives, and public sector investments. Expansionary fiscal policies increase government spending and reduce taxes to stimulate economic growth, while contractionary measures aim to reduce inflationary pressures and stabilize public finances. 7. Policy objectives. Monetary policy focuses on managing inflation, promoting employment, and maintaining financial stability through interest rate adjustments and liquidity management. Fiscal policy targets long-term economic growth, income redistribution, and public welfare by balancing government revenues, expenditures, and debt management strategies. 8. Collaboration and challenges. Effective economic management often requires coordination between monetary and fiscal authorities to achieve complementary objectives and mitigate policy conflicts. Challenges include balancing short-term economic stimulus with long-term fiscal sustainability, managing external shocks, and addressing socioeconomic inequalities through targeted policy interventions. Conclusion. Monetary policy and fiscal policy are critical tools for government and central banks to manage economic cycles, stabilize financial markets, and promote sustainable growth. Monetary policy focuses on adjusting interest rates and credit conditions to influence consumer behavior and investment decisions, while fiscal policy involves taxation, spending, and budgetary decisions to stimulate demand and support economic sectors. Understanding the differences between monetary policy and fiscal policy helps policymakers, investors, and the public assess policy impacts, anticipate economic trends, and navigate financial uncertainties to foster stable and inclusive economic development.